Welcome back to another episode of XVC Tech Insights, your weekly front row seat into how early stage chaos becomes world changing capital in the world of startups. I am Aneri Merchant, your host for today, and an investment manager at XVC Tech. XVC Tech is a $125 million fund backed by the founders of XDC Network, investing in early stage Web3 projects promising a high growth potential. Today, we've got a very power packed conversation with one of the most globally hands on accelerators and investor, ExpertDojo. If you don't already know them, they're not just writing checks, but they're building entire growth stories. Based in Santa Monica in the US, ExpertDojo is an international accelerator that invests in pre seed and seed stage startups from around the world. But they don't just stop at funding. They help with product strategy, go to market, investor connections, and scaling. Basically, they actually help the founders grow and scale. But before we get into some really fun conversations about Silicon Valley, about Web3, and also about Expert Dojo, let me introduce the audience to Brian, who heads Expert Dojo and has years of experience mentoring and investing in early stage projects. Welcome, Brian. Thank you for joining us on the very first Zoom podcast right from the US. Our audience would love to hear more about you and what do you do at Expert Dojo?
My pleasure. Nice to be here and lovely to be chatting about Web 2 and Web 3 and everything in the middle. So I founded Expert Dojo around 10, 12 years ago. We've invested in a couple of hundred companies. Since that time, we've invested in companies in India, invested in companies in Africa and the United States and all around the world. This is our world and what we love doing. Our belief in the beginning was that money in itself is an empty promise, and it's like solving the symptom of a cold rather than solving the cold itself. The actual solving the disease or the cold or the virus is going directly to the customer, and so we're very deep with regards to how do you do growth hacking? How do you work with customers directly? What does that look like? So yeah, we're looking forward to talking about all of that today.
Awesome. That sounds like a complete hands-on VC and an accelerator. So today my topic is going to be like diving into a topic that every founder globally just obsesses over. How do you get a investor from the Silicon Valley on your cap table?
And by the way, this is the problem. The problem is nobody should obsess over funding. People should obsess over their customers. I
Right.
read a LinkedIn post the other day from a founder who was talking about how to build a proper relationship between an investor and a founder the right way. An open letter from a founder. And I spent most of it trying not to get sick. It's like it's a love story. It's not a love story. It's not a love story. If I'm a general partner of a fund, which I am, I have one obligation to my limited partner. That's to make sure I get them better returns on their money than anyone else. It's not a love story. It's not a relationship. We're not holding hands walking down the road. I have to get them a better return than anyone else. If founders come to general partners of funds or angels or family offices or anyone else, it's not a love story. It's about trying to get money and showing that you can do a better job. And so, what everybody should be obsessing about is how to show that they have built a unique insight with a customer that actually loves what they do so much that their revenue is going to double every single year. And it becomes obvious for any investor to put money in their company. That's the real game. It's not about Silicon Valley, non-Silicon Valley. There's probably more money in Bangalore today than there is in Silicon Valley today. But founders focus on the wrong thing. Focusing 70% of your time on trying to find investors is like focusing 70% of your time and trying to find the right restaurant that you can have your first date in rather than focusing on the person that you're having the date with. People have got to get back to the customer again, or we're going to continue having this declining venture ecosystem where more and more founders try and more founders fail. But anyway,
Right.
sorry,
I think
as you were
what you
saying.
mentioned is completely on point because I had read a quote that build a product that you don't need to go to VCs for, but VCs come to you begging for funding that, hey, we really want to get into your cap table and, just you want VCs to fight to get a space on your cap table. So I think what you mentioned is completely right. Founders should obsess over building a customer-centric product and something that the customers love with a high repeat ratio. And yeah, I think that's the way to go.
And if you get money, it's a privilege. Look, my kid, I have never put him through private school, never got him his BMWs, never got him like his beautiful cars and his beautiful houses and his beautiful friends or his beautiful anything. He lives a normal life because living a good life is a privilege. It's not a right. It's not something that a founder starts off and they're saying, I don't know what's wrong with all these investors. They're not putting money. No, it's not. You're a nothing. Like you haven't done anything yet. You're pre-seed, you haven't arranged, and there's no right to getting money.
Right.
There's a right to providing exceptional service to a customer. That's an expectation. And once you do that, to your point, like investors need to make money. The objective of being a venture investor is that you will get better returns through a higher risk than investing in banks or gold or anything else that you can possibly do. I think venture is probably higher than crypto these days. Like, because even in crypto, you can kind of tell what's going to happen with XRP or
Yeah.
Ethereum, Bitcoin, or everything else. Maybe not the meme coins so much, but you can tell. And so, because of that, in venture, you have no clue. Early stage venture, up, down, up, down. You don't know where they're going to go. So, my only advice, and I'll probably get nicer as the podcast goes on, but I want to help people achieve stuff. Focus on your customers. Get traction, get your customers talking about you, share that content with investors so investors can see that you're doing an amazing job. Never spend more than 15 to 20% of your time engaging with investors. Don't be rude, but don't be desperate. Don't be sending out hundreds of emails every single day with multiple email sequences and LinkedIn follow ons and direct messaging through and paying investment bankers and paying other people to help you and learning how to pitch and doing the perfect pitch deck. Like, forget that shit. Just build a great product, put it in front of your customer, have your customer say amazing things about you, and then retweet and make sure that you loop in a bunch of investors and other people that are relevant to your growth.
I think that's gold. The advice that you just gave. That was one of my last questions on the advice you would give founders. But I think what you just said is very valuable because I think that what is maturing now is that the VCs themselves want to invest in more sustainable projects, in more sustainable startups, unless, of course, it's something that disrupts an industry. But even in Web3, we are seeing a shift from something that was investing purely based on hype, purely based on community, to something that is making revenue, something that's more sustainable over long term, over token price. So, this is the kind of shift that we have seen in recent times in Web3. Have you seen a trend based in US or talking to a few projects? Has that shift come to you?
So Web3 is different. Web3 is funny, right? It's different. It's not the same as Web2. Web2 is very much customer based. Web3 is, 12-year-old, 13-year-old teenager based.
Yes.
So if you have I kind of break. I'm also my realization with Web3 is I'm not very good at Web3. That's what I've realized. Like I'm very, very, very good at early stage Web 2 because I understand the dynamics. The dynamics are you get a great product, you build a great product, you put it in front of a customer tells the truth all the time. They never lie. You can get some false positives a little bit, but if you follow it through, you're always going to get to the ultimate truth. It is truly a beautiful thing. Web3 has a couple of things that are very interesting and a couple of things that are very dangerous. So the things that are very interesting is the liquidity opportunities in Web3 are much better than the liquidity and opportunities in Web3 technically, right? Tokenization rather than waiting 10, 12 years to get your money back is very good. But what's the problem with that? Because it's very difficult for startups to manage it. They either go too far or too soon. They either give total liquidity at the beginning, which means which is why 98% of tokens fail. And that is inherently a Ponzi scheme. Like that is the definition of a Ponzi scheme, which is that when most people know that the price is going to drop, but the early people in get in at the higher price, that's the definition. And that's kind of a problem for me. Are the projects keep long lockups in there so that they get held out. But the problem with that is that the market cycles are very short. And because the market cycles are not like 2, 3, 4, 5 years, then how you can have your lockup for a year or for 2 years, but that's no good to us. Like if
Yeah.
your lockup held us for January, February this year, you did us no favors. We just lost all of our money.
Right.
So Web3, and the other problem with Web3, and by the way, I'll do beautiful and problem. So I keep it very balanced. So the beautiful thing is I love tokenization as a model. The bad news is it gets abused, right? And it either gets abused or it's incorrect. So I've given you two examples of it being incorrect. An example of it being abused was what Trump did with his token. Like that was just robbery. It was
Yeah.
just I can't think of a better word for it. It was just stealing, right? And so, and that's an abuse of tokenization. And on another beautiful side of Web3, the key is very community focused, and I very much like that. And it's all about building great community, which is fantastic. The bad side of Web3 is that it's hype focused, right? So the hype goes up, everything goes up. The hype goes down, everything goes
Right.
down. So none of this is based on the customer. And that's a huge problem. And look, I'm a huge advocate of Web3. I've been around Web3 and investing in Web3 for about 13 years. And so I know the space very well. I was in, I had the Michael Turpins and the Brock Pierces and William Quigleys and all the early Bitcoin and EOS guys all in my place in Santa Monica like 13 years ago. And I loved the idea of decentralization at its core. I felt it was like one of the greatest revolutions of its time. The challenge with like great revolutions is it attracts scammers. And
Yeah.
so Web3 has attracted more than its fair share of scammers. So it's just very, when you have this like beautiful, difficult, beautiful, difficult, beautiful, difficult, it's very, very, very difficult to navigate your way through it. I'm a very experienced VC. And even for me, it's very difficult for me to navigate my way through an environment that's not customer focused. And
Right.
so I think all of this stuff will mature in the future. In the meantime, what's going to keep on happening is that people will get together in little rooms and decide which token is going to do very well. And
Yes.
lots of money will be put behind that token, and lots of bullshit KOLs will be put behind it who, if they weren't KOLs, they would probably be doing ketamine on the side of the streets. But like, so it is what it is, right? And if you're in the insight circle, I think you can make a lot of money from it. And I think again, to like balance, a beast with beauty, what will come from this in the end is a much better mix, right? There won't be Web 2 and Web 3 in the future. They will just be different financing models whereby we can get financing immediately or ongoing financing, and it will cross over to crowdfunding, and that will cross over to venture funding, and that will cross over to public market funding. Like I think it will all become one thing. But in the
Right.
meantime, we're in like a very dangerous market for amateurs. Like,
Yeah.
and so just beware, people.
Right. No, I completely agree to what you said, and that's a really good answer that you gave in terms of the beauty and the beast, because it sh truly shows that nothing is black and white. It's all shades of gray. And Web3, although it seems very attractive to people outside, but it has its own share of difficult situations that VCs themselves also need to deal with, right? So I completely agree to your point. But I think over the last couple of years, we have seen Web3 maturing, I would say, in the sense that, Bitcoins, ETFs being approved, institutions finally opening up to a Bitcoin reserve, and also a lot of retail money is going into, I would say, the top few tokens, Bitcoin, Ethereum, and probably XRP Solana. But with all the regulations such as the Genius Act come in and Trump being pro crypto, how do you think this affects the VC? in terms of its appetite to invest in Web3 projects? And which sector do you think would be a winner? Do you think it would be stable coins? Do you think it would be RWA or payments? What do you think would emerge as a winner out of this?
So I have great investments in stablecoins. We have a phenomenal company called Credit. I think Credit will hit $1 billion valuation within the next 2 years, not through Web3, but through Web2. Right? We were going to do tokens, but we realized that the tokens were never going to go to the people that they would have. It was about diaspora sending money through the Lightning Network to Africa, and backwards and forwards. And we were going to do a token, came very close to doing a token, raise money from a bunch of the Web3 folks. But then we realized the token was never going to go to the people that it would have really benefited. Like one side is the story of what the token is supposed to represent, and the other side is the reality of what really happens, right? And what
Right.
really happens is it's Vegas. And what's supposed to happen is this great community sharing, and the sum of the total is so much greater than the parts. But like none of that is really true. And so we ended up not doing a token, just doing it based on equity. But like all of the Web3 investors who got involved will do fantastic on that. We'll get 20, 30, 40, 50x on the company. And I think that company would probably exit within 3, 4 years. I think they'll do like a phenomenal job. So it's growing really fast because of the engagement and because of the product they have, which is right down our street. Um, I mean, I have like 4 or 5 other great projects in decentralized finance. I think one of the things that's been proven within crypto is it really only has one application today. There are plenty of discussions about future applications, everything from cyber to AI to real world assets to everything else, but they haven't turned into, from the beginning of time, doctors' records will be on the blockchain. Like,
Yes.
good luck with that. Legal is getting a little bit closer because blockchain is a better technology for legal, but even legal is no good. And even if you look at health records or medical, it's illegal, not illegal, but regulations won't allow you to use blockchain. So there's really just fintech that it works, but it works amazingly well in fintech. And honestly, I don't even mind if it's decentralized fintech or centralized fintech. Both of those areas are actually really, really good. I think the other thing is we're seeing like the world of crypto breaking into two places. At the very beginning, there was a quiet voice that said crypto is really only one token. It's really only Bitcoin. That's all crypto is. Everything is there at the behest of Bitcoin. Bitcoin allows other people to come in the room. And the
Yes.
moment that Bitcoin decides that other people don't come in the room, other people shall not enter, right? Those people have become much louder. And a lot of the people like me over the years that played with meme coins and then came into this and that and everything else, we kind of look back at our friends who just stuck, the Michael Saylors of this world, who just stuck with Bitcoin all the way through. And honestly, I think the Bitcoin people are probably the smartest of all of us because they're the ones who just got the steadiest returns over the years without the hassle of having 50 people in a room deciding what money to put into and what to come out of
Yes.
and where to leave and what cycle is going to happen. And so it's going to be two things are very interesting. One, as we go into a quantum age, it's going to be very interesting to see how
Yes.
Bitcoin holds up because we all know that the moment it gets cracked, the party's over
It's gone.
or it changes, right, in a really scary way. So I think that you're absolutely right. Like in some areas, it has really, really, really matured. But on the other side of the coin, like as I get older in life, I realize that a lot of the time, just the battle lines change. And the people who seem to be our awful enemy that were beating us up and hitting us and attacking us all the time, who are now our friends, they're really just our temporary friends so that they can make a little bit of so that they can actually forget making money. I don't even know that they want to make money. I think so that they can put themselves in a position of strength to attack much harder the next time.
Right.
So Trump's not going to be in office for long. The US has never been weaker than it is right now. The the detractors of the meme coins and a lot of the coins out there, which have got very little utility, are getting louder and louder and louder. At the same time, we're just about to enter a new hype cycle.
Yes.
And the next 6 months are going to be nuts. And so things are going to go crazy again. So I think sometimes like the crypto space is a little bit like a heroin addict, or I'm going to say a functioning alcoholic who loves partying,
Right,
but they function really, really, really well.
right.
So look, I love crypto. I love the idea of crypto. I love what crypto is doing. Crypto is super early right now. I think the very experienced funds like yourself who know what you're doing are the only people who should really be playing in crypto, and everybody else should be buying
Yeah,
Ethereum, XRP, and Bitcoin, and that's it. And just be happy. And then if you want to take like 1% of your wealth and just play and gamble like you would do if you went to Vegas, then God bless you. You should do
yeah.
that.
Yeah, no, that's completely good. I think crypto is not for the faint-hearted because over the years, like just over the weekend, we saw Pengu rise 40%, like you said, right? There are some coins which probably don't have much utility, but they still go up, and you really don't know why. So, yeah, I think probably a one
Based on their Twitter following.
based on
Like
their Twitter following and who tweets or retweets.
and who
Uh,
tweets? And that person who tweets or retweets was literally a 50-50, whether in a different life they would be in jail for 20 years or whether they would be a top KOL.
right,
Like, and the Twitter following and like even diligence, like for a lot of us, when we look at it, we'll base the diligence on Twitter following, like it's ridiculous.
yeah,
So yeah, but it is the game. And that
right,
is how the game is played. And that's why people just have to be terribly careful because they have to understand that everything is positioned in a place to create a certain emotion. And that emotion is not easily created. Sometimes it's spontaneous, but they are one in a million. It's like trying to find a lottery millionaire. The
right.
rest of them very carefully manipulated and put in place so that a desired outcome is achieved. And if you are not directing that game, you do not want to play that game.
Right. No, I 100% agree to what you are saying. And yes, there are a lot of nuances in crypto that till the time you are in it, you will not realize. It looks very glory and glorious from the outside, but inside, yeah, it's a rough sea that we need to navigate. There's one thing that I'm very curious about. I had come to Silicon Valley last year for the Plug and Play annual conference, and the energy in that room was electric, to say the least. There were around 4,000, 5,000 attendees, it, including founders, investors, all under one roof, pitching, closing deals, and even walking away with checks within the 3 day conference. So there's something that struck me that we have cities like Dubai, Singapore, Hong Kong, which have thriving VC ecosystems, but the valley still somehow steals the show. Is there any secret due to which there are so many startups that are based in US or probably get US based funding go public as compared to the rest of the world? Is there a secret sauce to this?
I'll make a prediction to you. India will be a better venture market than the US within 10 years.
Wow.
10
Okay.
years. The US market hasn't really changed much. Look, there's 1,200 unicorns in the world today, 1,260 or so, which is an increase from 20 years ago where there was about 15 or 20 unicorns in the world, right? So we have a lot more unicorns, like which are private companies, which are billion-dollar companies. And for like crypto folks, I'm talking mainly non-crypto because we all know that a company can become a billion-dollar company in crypto in like 30 seconds,
Yeah.
but then by 45 seconds, it can be down at like zero again. So I'm not counting crypto, okay? Sorry. But like
Okay.
just Web2, okay? Just to keep it very simple. And so, and those companies, like if we look back, gosh, like maybe even 5, 6, 7, 8 years ago, 10 years ago, probably, Silicon Valley had probably 50% of them. Now Silicon Valley is like 30, sorry, Silicon Valley, the US, like 50%. Now the US, like 30%. And you've got like another 30%, which is over in China. And then the rest of them are around the rest of the world. More, these are average figures, but pretty close. Now, what's very interesting is what's happened in the rest of the world. So in Europe, no change, right? Very mediocre amount of unicorns because Nothing much happens in Europe. Everything is very much the German way. Grow at 2, 3, 4%. Too slow growth, not a venture backable company, no interest in venture money going over there. So you'll have a lot of private equity money in markets like London, Germany, and Spain and other types of places. Then let's take the UAE and the MENA region. MENA region's had a very tough time. And is that a tough time? Because you've got all kinds of turbulence going on over there. The biggest countries like Egypt have had a disaster over the last 10 years. They're like their currency is through the floor. So you might get a few unicorns in Egypt, but very, very, very few. And that's not going to change in the near future. The UAE is great, but look, when mommy and daddy gives you $1 million for your 18th birthday, it's very hard to incentivize people to go through what you need to go through to become a great founder. Great founders come from adversity. Almost 9 times out of 10, the only time there's a difference is if they go to Harvard or Stanford or one of the schools. Mommy or daddy works for A16 and they give them a unicorn for their birthday. But like with the exception of that, the vast majority of other founders, they actually have to get out of bed in the morning and go
Yes.
and work, right? And so the UAE have a problem, and it's a problem of motivation, right? India don't have that problem. And let me do Africa and I'll finish with India. Africa actually had 5 or 6 unicorns 10 years ago, 8 years ago, 5 years ago, and they still have 5 or 6 unicorns. Hasn't changed, right? Because they've got four main economies that they're driving the unicorns from: South Africa, Kenya, Nigeria, maybe, well, definitely. But even Nigeria is like, and Ghana, but like even Nigeria is very tough because the currency's up and down and everywhere. Now, I think we will have one, if not two unicorns in Africa from Expert Dojo. So I think we'll do great, but there's still only 5 unicorns. It hasn't changed, right? Maybe that will grow to 6 or 7. India had 10 unicorns 5, 6, 7 years ago. How many unicorns would you say
I think
today?
it's upwards of 100.
130.
Yeah.
So where would you go if you're a venture capitalist, right? It's all happening in India. No
Yeah.
change anywhere else in the world, stroke come falling down. India has grown 10x. Like you got to be an idiot not to be investing in India right now. More reasons. IIT, 30,000 mini baby geniuses coming out of school every year. Another reason, India moms, worst, most difficult moms in the entire world if you want to be an underachieving educational
That's true.
failure. You're done. You're finished. You're over. You're out of the house. You're gone, right?
You
So we have,
always compare to your next door neighbor, right? That he did this, why aren't you doing it? So
yeah, you're
that's
done.
what you grew up with.
Even if you're a great doctor, you're still not as good as the doctor next door. So that drives incredible greatness, right? And then match that with IIT, match that with like where India's come from, match that with the fact that all of the great Indian founders that were sent over to Dubai and America and everything are now coming back to India. Forget it. Don't waste your time. Don't look anywhere else in the world. Look in Bangalore and look in some of the other cities around India, and you're going to see India grow from 130 unicorns to probably 400 unicorns within the next 10 years. Like
Wow.
guaranteed. That's why for us with Expert Dojo, our whole thesis is owning the bridges. We want the bridge between India and the US and India and the rest of the world. That's where all the money is.
That's very humbling to hear so much positivity about India coming from you, sitting in the US and having so much of experience. So, definitely proud of my roots, and I'm looking forward to your prediction coming true in the next decade, India being number one in this. So, there is also a lot of concept about secondary liquidity, right? Now, as much as we invest into a good company, a promising company, but till the time we are able to get secondary liquidity, our investment, at least on paper, is worth nothing, right? Even though the valuation is higher. What do you think about the secondary liquidity, and how do you really create efficient rails to ensure that one, your project is getting funded at the right time, and also you as an investor get an exit when you want to.
So secondary liquidity in good markets is available, and in bad markets, it's not available. The US has had really bad markets for the last 4 or 5 years. Ever since 2021, it's been terrible. Since Trump come into power, it's got double terrible. And so the markets are just really bad. And if you think about it, we haven't had many IPOs over in the US. Acquisitions are not great. The tariffs have caused even more concern from people looking in from the outside. It's a really tough time. And then people are also worried about an impending recession, which is coming as well. So I
Right.
just think it's a really, really tough time right now. The secondaries come after Series B. You just have to make sure that your company's going fast enough. Like I mentioned, credit. Like there's no doubt in my mind that credit will be very strong on the secondaries market within 2 years.
Wow.
Not today. They just raise it like 100 plus, but like they won't. So not now, but like when they're raising at like 400 or 500 million, it'll go on the secondaries market, and then you give a 30% discount, you get your money out, and you're very happy. Like that's how it works. So it'll come back. They come in ebbs and flows. And you also have to be careful of secondaries as well because you can't do diligence. Like I remember when Blue Smart were coming out on the secondaries, and
Yeah.
oh my goodness, was there lots on Blue Smart? And
Yes.
when you asked for, and we looked at it, but when you ask for information, it's like, come on, you don't get information because it's on the secondaries. But this is a great company, and then you
Yes.
look at it and you're like, well, the founder kind of owns the car company that supplies the other company, and there's
That's true.
it looks kind of scammy, and then it ended up kind of very scammy. And so
That's
you
true.
just have to be very careful. Again, it's not for the faint-hearted. You need to be a very good investor. If you're buying on the secondaries market, you want to just make sure you know what you're doing. And if you're selling on the secondaries market, then you just want to make sure you're not getting rid of an asset that could potentially go up in the future.
That's perfect. Yes, I think that's really good advice because what we actually as VCs, even though we've invested in a project that's really very good, but in absence of an active secondary market, even we wouldn't be able to achieve the returns that we would ideally want to. So
No, and
that's
the other problem, to your point, is that LPs right now are looking for returns,
yes,
especially in the US. LPs are very frustrated with a lot of the big VCs because, and the small VCs, all of us actually, because they know that they're not getting the returns that they're expecting to get because the market's very, very quiet. And so that's causing a lot of people to get nervous. And the problem is when people get nervous, they do stuff that they wouldn't normally do. So I think it would not surprise me if we see the market becoming more and more panicky over the next 3 or 4 months.
so, do you think the J curve that is usually there in venture capital is getting a bit more skewed because of the absence of, say, secondary liquidity, or because of impending recession, or because of the impatience of the LPs? This curve, how do you think is going to span out?
I think it's just really funny right now because you have crypto people who are looking for exits in by Tuesday. And then you have venture people where the exits are taking longer. But then it's more complicated on the crypto side because it's just for all the reasons I said earlier on. And on the venture side, whoever can have the patience. Look, I still believe, I maintain that I've always found Warren Buffett to be an amazing investor. And the more we've watched him over the years, the more it's incredible. Like you watch him like go on his slow horse and everybody
Yes,
just like races by and then the slow horse passes by in the future. My belief has always been early stage, customer loving technologies is the best place to invest. I just believe it. I think if there's a Web3 angle to it, I love that. That's great. If there's a token attached to it, I think I love that. It's great. But early stage. I think Y Combinator are the smartest people in the world and their model is really good. And all we did was we just took their model and we just layered on a public market aspect to it, which is in warrants, and then a private equity aspect to it, which is coming in and taking over companies as we see they're doing very good. Like that's literally all we did. We took what we thought was the best in private markets, the best in public markets, and then the best in private equity and just looped them all into one model. Now, that will yet to be seen, but it requires patience. And very few people have patience today. So I think in the words of Warren Buffett, like we'll see when the tide goes out, we'll see who's wearing swim shorts and who's
right.
not. One thing, like having now been in investment for a long time and having invested in hundreds of companies, my advice always to people is don't change your thesis based on short-term reasoning. Like
Yes,
you stick with your goals. If they're working, if what you had planned to happen over a period of time is still happening, irrespective of the pressure that's put on you, you stick to your goals.
right.
But if it's
Yeah.
not working, then you add in interim measures to make sure that you hit those goals.
Right. And I think
And
this is very true. But like what you mentioned, right? That every fund initially has an investment thesis that they believe in, and the stage at which they want to invest, and what type of companies they want to invest, and all of these things. Now, compare that with Web3. It's weird because the narratives keep changing every cycle, right? Now, probably this cycle, it was initially all about RWAs, then it was all about AI. Now suddenly it's all about stable coins. So in the last 1 year, we've had like three investment theses. So I am just trying to understand the shift in terms of a Web 2.5 VC. If someone is really investing in, say, Web 2 as well as Web 3, for them, it gets really very confusing. Do you go based on the narratives? Because
the customer,
narrative,
only the customer. My life is very stress-free. The customer never lies to me,
yes, the
ever.
numbers don't lie.
Yeah, the customer never lies. They always tell the truth, always. And if they like something, they'll buy it. If they like it a lot, they'll buy more of it. If they can't do without it, then they'll buy it at like midnight and 1 and 2 or 3 o'clock in the morning. Like they just never lie. And
Yeah,
so I was on stage the other day with a bunch of other VCs, and I had one of the VCs who's an AI VC, and they were moderating the conversation, and they said the AI is huge and it's great and it's everything. And I said, honestly, no disrespect, but like AI for us is bullshit. Like it's not
yeah,
important because the great AI, the open AIs, and those, we're never going to get to touch those companies.
yeah,
They're already snatched up by the greatest companies. So we're messing around looking for who's got the next AI agent to help do sales outreach calls. Like
right.
that's a commodity, right? That's nothing. And so for me, what's much more interesting for me is what damage is AI going to cause that's going to allow an
Hmm,
opportunity to invest in an area that's going to be able to grow faster because
that's
of what
interesting.
has happened in that area. And so again, the customer. So my thesis for the last year, and we've doubled down on one of our companies now, Matchbook, that we love, Indian founder, Indian development team based over in the US, but other than that, it's all Indian. And they are in the space of data integrity. Data is going to have a nightmare over the next like 6, 12 months, 24 months, 20, all these times, because AI is going to cause a problem there. Power is going to be a huge problem, compute power, especially because
Yeah.
of AI that's happening there too. So, just look for the damage that's caused by the thing rather than just chasing the thing.
That's a very good, fresh perspective in terms of AI that you've given. And really, really, that gives me a lot of different things to think on when I go to bed at night today. So thank you for this. So, over the years, we've seen a lot of instruments, financial instruments come up, more in this, the Y Combinator safe, which has been extremely popular in the US for raising money, especially when the company is growing and, you don't want to set a valuation. In token, we have seen a different structure called the SEFT, which is equivalent to the token equivalent of the equity, but also equity still holds good in sometimes in the web 2 and 3 cases. So from your perspective, what would you advise founders? What is a good instrument to raise money on, and at what stage should the founders prefer that instrument over the other?
I mean, the US people very seldom do equity before Series A. Simply because if you do an equity round, it's like $20,000. And so it's a little bit like paying a deposit for Harvard when your kid is like a year old. I'm like, okay, but like your kid's a year old. And you could do a lot of other things with that $20,000. And so safe notes is just very simple. Take them off the shelf. You do them. They're debt instruments. They're better than convertible notes. Like we used to use convertible notes, but convertible notes, the problem is if the founder doesn't raise a round, then you could end up with a unicorn where no money was raised and they just like pay you back your money, which is very sad. While safe notes are just good. They're just good. And the other thing is as well, like a lot of the people will talk about like, well, if I have a convertible note, will I get paid back? Well, not really, because
Yeah,
if a founder can't, if they don't make it, they ain't paying anybody back. Like nobody's getting their money back on
that's
that
true.
round. And there's no equity. There's just the company that you have. So I think that like safe notes are definitely my favorite prior to Series A. Once you get to Series A and you're raising like $5, $10 million, knock yourself out, dude. Take full equity in the company because that definitely gives you more rights in the company. But now you have a company worth having more rights in. But prior to that Series A, yeah, make life easy on yourself, especially if you want to invest in multiple companies. Don't increase the cost. Europeans, they do equity for everything because it's just silly. They like
Yeah,
spending money on early stage rounds, and attorneys love charging money. So it's a great match.
yeah.
In the US, in that one particular case, they're much smarter and they do safe notes. I like
Right.
safe notes.
Right. I think that's very interesting because, like you mentioned, the founders in the early stage should focus more on building their product, getting customers, getting numbers, getting traction, and not spend a lot of time, back and forth, negotiating the valuation, and then just pissing off the investor because of some absurd valuation that they may come up with. So raising safe
Oh,
notes
well,
at an
although a safe does have an inferred valuation because the
yes,
safe will have a cap. Like what always is amazing for me is if somebody has like an uncapped safe or the safe is at the next round, then I would like, why would anybody? I never understood why anybody would do that. Like, why
yeah,
take the risk at this round so you get like some shitty 20% discount for the next round? Like, you're not interested in that. Like the honestly, the only benefit really for me on the safe note is just that it's very simple, it's very easy, and it doesn't take a lot of time to do. There's no reason for the founder to want to have equity. There's no real reason for the investor to want to have equity at that stage. It's
yeah,
actually a very equitable relationship where both should just get a safe note, put it in place, and just do it fast. But just one thing to be aware of, just for founders, what I do see a lot in India that I don't see in other places is like everybody loves to invest their $5,000. So you can just have too many people on the cap table.
yes,
That gets super messy. And when a VC likes you or me, and we see like 5,000 people all on the cap table with like 2,500, like, you know what? I would rather just put my head in the water and drown than
that's
invest
true.
in the company because it's going to be pain. And because these little people who put small amounts of money in, or big people who put small amounts of money,
Yes.
like they're always the pain. They're always the ones who complain.
Right. I think minority shareholders and especially friends and family around, right, in the initial stages, a lot of projects raise money from friends and family. So $5,000, $10,000, which actually gives them a seat at the cap table, probably at a good minority percentage. So if eventually when a VC comes in, there's a lot of cleanup that needs to be done on the cap table. So in that case, the secondary capital becomes very important, and you need to clear up the cap table before you go to the next round. So otherwise, no VC is going to be interested in dealing with so many people at any point.
Yes.
Okay, so thank you, Brian. This was an amazing conversation with lots of insights. Now, before we let you go, we do have a rapid fire round, and this is going to be a series of short 5 or 6 questions, and you just need to answer immediately, something that just comes in your mind. So, are you ready for that? Okay,
Hmm.
so one red flag that you see in the pitches that founders give you.
Oh, yeah. Whenever the revenue goes directly up to the right for the projections. I have a
That's true.
friend who said to me, "Show me a founder's projection page on their website, and I'll show you a lie."
Oh, wow. Oh, nice. That's good.
Everybody projects this beautiful world where we're going to do 5,000% growth. And it's like, come on, you're like
That's true.
smoking crack cocaine. Like, you're not going to do that. I know you're not going to do it. You know you're not going to do it. Your customer knows you're not going to do it. Like, give realistic projections.
And the funny part is they hire an investment banker who will actually prepare the projections for them.
No, everybody can do like the most amazing
Yes,
projections. Amazing. People are amazing at doing projections. It's actually real work getting the real life getting revenue from customers that actually that tends to be a bit harder.
that's true. Second question, one metric that never lies.
Customer,
One
just the
piece of
customer, just the customer. Everything the customer says is the metric that never lies.
so customer is your green flag, I would say, while evaluating
Yeah.
a pitch.
Yeah.
One piece of advice for a founder setting up outside the US.
Setting up outside the US. So that is a founder that's setting up in their own country outside the US. I don't think the US is all that. I really don't. There are 8 billion people in the world. Like, you're only looking for two types of people if you're a founder. You're looking for customers 90% of your time, and you're looking for investors 10% of your time. Customers are either in your region, in which case it doesn't matter. You want to set up the company that you're going to set up, which is going to be best for that region. In a US environment, that's going to be a C Corp because you want to make
Yeah.
sure you have it in a way that you can get investment
Yeah.
from other investors. Nobody will invest in an LLC. In other countries, there are similar type laws that are in place as well. But you set it up in a way that the investors can invest in your company. There are investors everywhere. You don't have to worry about America. And if it's for customers, it's exactly the same. You make sure that you're protected in a way. I just always say, look, for me, setting up a company is always the thing you do with an attorney. If you're an attorney, you don't need the most expensive attorney, but you need someone who's worked in venture law before.
Yeah.
That person sets up your company and then you go to work. If in the future, as many of our companies have found out, if they find out, oh, we want to move our domain to the US, that's absolutely fine. They can do that, especially if an investor in the US wants it a domain-based a company for the future. But in the short term, you focus your company on where your customers are.
Got it. Have you ever passed on a deal and regretted it, and which eventually went on to be a unicorn?
No.
Okay. Which,
It's not that I haven't passed on a deal that has become a unicorn. I've never regretted it. Like investing, it would be like saying, have you ever looked at 100 lottery tickets, chosen one, and regretted that you didn't take the other
yeah,
85? Like, there's just like, I love when founders break through. I want founders to break through. There's more than enough money to go around for all of us. We
yes,
shouldn't be finding every single unicorn, but we should be encouraging every unicorn to become a unicorn. So if they become a unicorn, whether we've invested or not, I'm delighted.
interesting. One Web3 project you are keeping an eye on.
Well, sorry, one.
Web3 project that you are
Oh,
keeping an eye on.
a Web3. So I really like so I know we spoke about stable coins earlier on, and I really like stable coins, which is why I mentioned credit. I really like how fintech is changing and how decentralized finance is changing. I really like how BRICS kind of created World War III on the US currency and on the UK currency, and kind of how that is then spread out to all of the things that are happening right now within digital currency. So like leaving aside fintech that I really like, I also think the intersection between Web3 and Web2 is very interesting. Our digital and analog, should I say, is very interesting. So I'm looking at a lot of onboarding and offboarding in that area. We have one of our companies, Zeev, that are in the space of decentralized rollups as a service. I like that because it's making building in Web3 simpler for people outside. They're like building the Shopify of Web3. I have another company called InvestGo that are allowing people to be able to move money from one place to another place, but they can move it between fiat and between cryptocurrencies in a very easy way. Like I like that too because it makes it simple. Like it
Right.
means that you don't have to get a wallet. You just get yourself a bank account, and the wallets are built into the bank account and allows you anything that makes a thing that's difficult. Remember what I was saying earlier
It's
on? It was not
easy.
it's AI that I like think about. It's like the problems that AI that they cause that provide opportunities for investors like you and me. It's the same thing in crypto. Crypto is inherently difficult to get involved in. That causes an opportunity. And so that area of opportunity is the area that I want to look at and investing in. And for me, it's the facility of allowing the other 92% of the planet to be able to get access to crypto in a very simple way.
Right. Interesting. And one last question. Are you guilty of checking your phone first thing in the morning to see what crypto positions and where your portfolio is at?
No.
No, you
But
don't check coin market cap in the morning the first thing.
I think I should. I think I should. I check my email first thing in the morning and I check my text after that. I'm a very obsessive person and I get like 200 to 300 emails a day. So I get up at 4:30 in the morning normally and I'll clear my emails and I'll clear my texts and I'll clear everything else. And I don't get on to the fun parts of my day. This is, by the way, the same thing I say to my kid. I'm like, life can be wonderful, but you got to get the nasty stuff out of the way first.
Yes.
If you focus on the good stuff at the beginning, all that's going to happen is it's going to distract you. If you
Yeah.
focus on the nasty stuff, my emails are the nasty stuff. Like 300 emails is anxiety for me. So I
Yeah.
want to clear that. That's nasty. Once that's done, then I deserve to be able to treat myself by checking positions and checking everything else.
Thank you. Thank you, Brian. You've given a really good overview of what founders should do in the early stage, what VCs look for, and there are amazing takeaways. And I think this is one of the most insightful episodes that we've filmed so far. So thank you so much for being a part of it. And audience, just as a wrap up, what we've realized that early stage is actually where the magic happens. It's messy, it's unpredictable, but it is also where the foundation of billion-dollar companies are made. So whether you're building in San Francisco, Singapore, or even Dubai, Sharjah, wherever, the fundamentals still matter. Customers don't lie. Build trust, show traction, and signal conviction. This is what we've learned from Brian today. Thank you so much, Brian, for joining us on the podcast. And it was an extreme pleasure to host you. And to the audience, keep building, keep innovating. Thank you so much. Brian, any last words you would like to give the audience?
No, anybody who's listening to this, it's because they love early stage startup, and that means they're already on an incredible path. So just go out there and build something beautiful that the customer loves and transform the world. Easy as that. Everything else comes with that if you start there.
Words of gold as an advice for the founders. Thank you so much, Brian. It was an extreme pleasure to host you today on the podcast, and hopefully see you soon in person when you're in Dubai.
My pleasure. Right back at you.
Yeah, thank you so much.